Hey everyone, welcome to video 2, which covers Unit 2, New Zealand Tax Fundamentals 2. So continuing on from the last video where we kind of set the stage for how the New Zealand tax system works, in this video we've been talking about the framework that registers tax returns, which is the New Zealand self-assessment tax regime, where you actually report the income to the government or the commissioner. And also, what are the powers of the commissioner? You know, if someone is not submitting the returns or, committing fraud, etc., what does the commissioner have the powers to do in those situations? We'll also be talking about some of the other obligations in the system, such as withholding obligations, for example, POAE, which is, what your employer withholds from your salary, some of the deductions from payroll, provisional tax, which is basically making installments on your tax before it's paid. And then we're going to be talking about the ethics of tax. So, what is the difference between tax planning, tax avoidance, and tax evasion? And we'll talk about ethics and the penalties that the commissioner can issue. What are some examples of that? So it's a relatively short chapter, especially compared to the first one, and it's not particularly complex relative to the other chapters. So not a difficult one, to be honest. So let's just get started. So let's talk about the system first of all. So New Zealand operates in a self-assessment tax regime per Section 92 of the Income Tax Act 1994. So what this means is and this is how most tax systems around the world operate, is the commissioner can't go and lodge the returns for everyone. They can't audit everyone. He just doesn't have the resources to do it. The cost would outweigh the benefit. So the system works on a self-assessment basis, which basically means everyone lodges their own tax return, everyone needs to be across the rules, and everyone will be responsible for the outcome. So the commissioner plays more of an enforcement role, right? So they go and, they'll run the numbers and look for outliers and do audits on those and just look for odd things and check it that way. But, at the end of the day, it's really an honour system by, New Zealand taxpayers that they actually submit the right thing, because the commissioner can't always, find every instance of fraud and error, etc. So the commissioner is basically, as I said, the commissioner is responsible for running of this self-assessment system, the administration of it. So there's typically 4 phases in terms of the collection of tax by the commissioner. So number 1, imposition, which is, in other words, the collection of tax. Then there's quantification, which is actually the assessment, so it's the lodging of tax returns and converting that into a certain form which has numbers in certain categories, etc., that they can process. Number 3 is the dispute resolution, and this is where, because there's so many grey areas in tax, actually coming to a conclusion on those, especially in terms of interpretations and things like that on complex or vague acts and things like that. And then finally, collection, which is actually, we've lodged the return, we're all agreed on the same page in terms of how much everyone owes, but how do we actually get the money from people? Because that's a huge problem in itself, in that, most people, if you just bill them at the end of the year 30% of their income, they're not going to be able to have the cash to pay it back. So what the commissioner does, as well as in many different countries around the world, is they have this system of withholding taxes. So when you get your salary, that's why they withhold, 20 to 30% of it by your employer and pay it throughout the year to the government. It's so if they didn't, the majority of people just wouldn't be able to pay their tax at the end of the year. So it's really to help with collection and cash flow and enable that. So in terms of what powers the commissioner actually has, it's got quite a few, especially in New Zealand. So number 1, and these are going to sound like, police powers really, but search and seizure powers. So what the commissioner can do is he can require certain documents to be produced. He can say, I want, the last 3 years of records. He can also require taxpayers to answer questions on oath, and can access and search taxpayers' homes and businesses and seize documents found there. So the second power of the commissioner is assessment, litigation, and collection of tax. So the commissioner has a wide range of powers available to them in assessing taxpayers' liabilities, administering the self-assessment regime, etc., which are listed in the tables down below. So categorized by assessment, collection of tax, and litigation. So in terms of assessment, they can assess various tax and duty types. They can assess income tax where taxpayers fail returns. So what these points basically mean is, if no one's lodged a return, the commissioner is going to say, well, I'm going to lodge it for you. I'm going to do my best guess. I'm probably not going to claim as many deductions as you would ordinarily, because I'm going to do what's in my best interest. I'm going to lodge a tax return based on an assessment. So they have the power to do that. They also have the power to amend a taxpayer's self-assessment, right? So even if the taxpayers lodge something, they can just go and change it themselves and just issue them the new tax payable amount. And they can also determine the amount of provisional tax owing. And the relevant section from the Tax Act is listed on the right-hand side. Now, in terms of collection of tax, the powers of the Commissioner include commence debt collection proceedings in the District Court or High Court, which basically, if you've got a tax liability to the, Commissioner, including potentially one which the Commissioner has assessed themselves and just said, look, this is what you have to pay, and if you don't pay it, I'm going to go to the court and force you to pay it, and then they can, collect that off your other assets, whether it's your house or your car, and just force you to sell those in order to pay down your debt. They can also require third parties who owe money or hold money on behalf of a defaulting taxpayer to pay that money to the Commissioner in satisfaction of tax debts. So whether that's a loan or owing, or whether that's, maybe it's a withholding tax that's been set aside, or even potentially bank accounts, the Commissioner will just go and say, look, we have this debt, we're going to collect this asset that the other taxpayer owns or is owed to, and we're going to collect that to satisfy their tax debts. And then finally, to have a charge, i.e. a security interest over the property of any party in default under the PA rules. So for example, just like the bank has a security interest over your house in a mortgage, the New Zealand government can do the same thing in terms of if you owe a tax debt to them, they could potentially say, look, we're just going to claim an interest over your property because you haven't paid our debt. And of course, if they have a security over your asset, they can liquidate it to pay the debt if they want. And then finally, litigation, which is the final category within this number 2 point, is the powers of the Commissioner in this category include require disputed tax to be paid pending resolution of dispute. So they don't even need to have a conclusion on a certain tax dispute. Let's say that someone's taking them to court, or got an arbitrator to kind of help them decide on an outcome for a certain dispute on a vague tax law. The tax commissioner can say, look, I know we haven't come to a resolution, but I'm going to collect the money from you anyway. That's within my right. So they can also apply to transfer proceedings in the TRA, or the Taxation Review Authority, to the High Court and vice versa. So basically escalate certain proceedings. They can designate a case as a test case, which is a test case is basically something which will almost set a precedence in the tax community. So if there's a certain case that they want to, it might just be a small case, but the New Zealand government's going to put all its forces behind it and put extra resources behind it, just so that they can then set a precedent and say, going forward, this is the outcome of it. We're going to hold everyone accountable based on the outcome of this test case. Obviously, it's not good to be on the other side of that, because the government's going to be putting additional resources than they normally would into your case, including with lawyers fighting it. And finally, stay other cases from proceeding pending resolution of the test case. Okay, so the third point in terms of what the Commissioner can do is pre-assessment dispute resolution process. So this is basically this is before the tax return's even been assessed. They can go ahead and do all of these things. So issue a notice of proposed adjustment, which is basically, we're going to make a change to your tax return. So this is a notice outlining what we're going to change. Notice of response, disclosure notice, statement of position, extend time for taxpayers to respond, seek extensions from the High Court for the Commissioner to complete the disputes process, or suspend proceedings because a similar case is a test case. And then finally, point 4, which is granting relief, so just like the Commissioner has a lot of negative powers in that they can, ask you to pay more tax, they can audit you, they can request files, they can increase the payment amounts, they can do a lot of bad stuff, but they can also do good things as well, which is they have the power to exercise their discretion and grant relief. So what that means is, here's a couple of examples. They can write off small balances. So if someone owes the tax Commissioner, $100 or something like that, it's not really worth the effort. So what the Commissioner can do is they can just write off that amount per section 174 AA. They can also grant relief where recovery of outstanding tax would place the taxpayer in serious hardship. They can allow the taxpayer to enter into an installment arrangement for payments of outstanding tax. They can write off irrecoverable tax on bankruptcy, liquidation, or death. They can remit penalties for reasonable cause. i.e. the event arose for something beyond the taxpayer's control, they can remit various types of penalties if that would be consistent with the Commissioner's duty to collect over time the highest practicable net revenue. So these are all powers that the Commissioner could potentially use to do good things, including, reducing people's tax payables, whether that's due to hardship or just it being an immaterial amount. And then the final point that we're going to talk about in terms of what the Commissioner can do is in relation to binding rulings. So what a binding ruling is it's the basically the Commissioner's interpretation of how a tax law applies to a particular arrangement. So for example, whether it's the deductibility of interest from an offset account, quite a specific area, but what the Commissioner will do is they'll issue this ruling and it will say, this is how we interpret the case. We believe it's going to be deductible or not deductible, and we're referencing this Section Act, this case law, and these other, maybe a test case, for example. So there's different kinds of rulings, right? There's three types. There's public rulings, private rulings, product rulings. So a public ruling is a general interpretation rule applying to the public. So it's an example of what I mentioned before. It's a specific area which is quite maybe complex or vague, and they're saying, look, this is how to interpret it in case you're not sure. Given it's quite a vague area, just follow this, and this is just how we will agree to treat it. And then you've got private rulings. So any individual can apply to the Commissioner to have a private ruling on a certain thing, whether that is, I want to sell my business and I'm not sure if I'm going to, pay tax on it or not, and it's quite a specific or complex area. So what they can do is they can write to the Commissioner and say, can I get your view on this beforehand rather than me submitting my tax return and then you coming and auditing me. I just want some sort of clarity beforehand. So you can go ahead and do that, but the Commissioner won't do it for just small things or existing things where there's a public ruling, for example. Must be for quite important material issues. And then finally is product rulings. So what this is that instead of applying to general issue to the public, it's a rule which is applying to a very specific financial instrument or product. For example, I gave the example of mortgage offset accounts. Now this would be interpretation specifically to a mortgage offset account, whereas the public ruling might be an interpretation on a specific, one of the acts maybe, or a treatment of a certain, tax issue, whereas this would be a product. Mortgage offset would be the product in this case. Right? Okay, so next issue is, we're no longer talking about Commissioner's powers, we're just talking about general issues within the New Zealand tax framework. So it's about withholding obligations. So I've mentioned a couple of times before that one of the Commissioner's roles is the collection of tax. And obviously, cash flow can be a difficult issue with many taxpayers, which is why we have withholding obligations. And it's not just, individual employees with their salaries, but it's also, for example, international residents who, if we don't withhold the tax, they might just not lodge the tax return and might leave the country, never pay the tax, and that money is gone. So you might also have to withhold it from the purposes of, we're thinking that we're not going to get the money again. But for most employees, it's just about cash flow issues. So the main withholding obligation is to do with PAYE, which is employers filing and obligations. So under RAA 5, bracket 2, an amount of tax must be withheld from a PAYE income payment at the time a person, i.e. employer, makes the payment. For an employer who withholds gross amounts of PAYE, including super contribution tax of less than $500,000, the tax withheld must be paid by the 20th of the following month. And for other employees, PAYE tax withheld that relates to salary and wages paid between the 1st and 15th of the month must be paid by the 20th of the same month, while tax withheld relating to salary and wages between the 16th and the end of the month must be paid by the 5th of the next month. And if the employee's total PAYE and ESCT deductions are $50,000 or less, payroll reports can be filed using prescribed paper forms with a due date of 10 working days after payday. So more or less, when you withhold tax, you have a very short period of time, basically around 5 days to actually pay it from the time you've collected it to the government. That is, unless you've got less than $500,000 in tax withheld, which means you're a smaller business, which gives you a little bit more time to lodge it up until the 20th of the following month, so basically 20 days. So There are also other deductions from payroll, which are either withholdings or just amounts that have been subtracted for various reasons, whether that's a superannuation payment like KiwiSaver, whether that's a loan deduction to actually pay off your student loans, or child support, right? In either case, it's money that's been taken out of your gross salary, similar to PAYE, in order to pay off a certain thing. So let's go through each of them. We've got 7 in total. So the first one is ACC, or in other words, Accident Compensation Corporation Earners Levy. And this is basically workers' compensation insurance. So all employees must pay an Accident Compensation Corporation Earners Levy to cover the cost of non-work related injuries. This is collected by IR through the PAYE system on behalf of ACC. This levy has been built into PAYE tables, therefore no extra deduction is required. So in other words, the PAYE deduction, or withholding I should say, is all the employee needs to deduct in terms of this. We're just noting that within the PAYE withholding, it also includes this ACC earners levy. But the only difference is not all of the PAYE will be going towards the individual's tax at the end of the year. It'll be, say, 95% of it, with the rest going to ACC. So the next deduction is employee contributions to their superannuation. Now in New Zealand, that superannuation is called KiwiSaver. So employees do need to deduct employee contributions from the respective wages or salaries who are KiwiSaver members. It's not compulsory. In fact, members of their super fund can actually contribute a higher amount, so they can actually choose the amount they're going to be contributing. So employers are also required to make compulsory employer contributions to employees' KiwiSaver accounts. So just to clarify, there's 2 components. There's the component that the employee contributes, and that's optional, and then there's the component that the employer contributes, and that is compulsory. So any KiwiSaver contributions by the employer are subject to contribution tax, which is called ESCT, or Employer Superannuation Contribution Tax. Both employee and employer contributions are paid through the PAYE system, along with any ESCT payable. So again, this comes through the PAYE, so it's withheld each month from the gross salary and paid along with your ACCC, PAYE, and other deductions, which we'll talk about. So the next deduction that we're going to be talking about is student loan deduction. So employers must deduct loan repayments from the wages of employees who are paying off student loans. Student loan repayments amount are included in the POE deduction tables through the use of specific tax codes and must be paid along to the IR along with POE. Next one is child support. So this is basically, I'm sure you know what child support is. It's basically when you get divorced and the court determines that one of the parents needs to contribute, usually the man, needs to contribute child support to the parent who's raising the child. And again, this comes through PAYE, and employers may be required to deduct those payments from employees' wages where it's not an optional payment mandated by the court. So the next point is payroll giving. So employees who wish to make regular donations to eligible charities causes through payroll can do so if their employer offers a payroll giving scheme. Employees who make payroll donations will receive an immediate POE credit for any pay periods in which donations are made at a set rate of 33.33% of the donation that is made in each respective pay period, and reduces the amount of the PAYE deducted. So the next POE withholding is a resident withholding tax, so also known as RWT. So this is payable when resident passive income is paid and none of the exceptions apply. Taxpayers may use RWT deduction from payments made to them as a credit against their income tax liability for the year. RWT is refundable if taxpayers have overpaid their income tax liability for the year. So what this is it's, if you're a resident and you receive passive income, whether that's, dividends or royalties or whatever it is, this is a means of, similar to PAYE, collecting money from passive income to improve and help with cash flow issues at the end of the year. Once they lodge that and realize they have to pay a huge amount of money, but they've already spent the money. So that's why this was introduced, in order just to set that money aside so that they could satisfy their income tax liability without any cash flow issues. And then the final withholding that we're going to be talking about is obligation to deduct RWT. So similar point to the one above. So the RWT apply to a person who makes a payment of resident passive income. So resident passive income includes interest, dividends, some taxable Maori payments, and some payments under share lending agreements. So the person must be a tax resident for New Zealand and or a non-resident carrying on taxable activity in New Zealand through a fixed establishment. So there's a couple of exceptions to the requirement to deduct RWT. But basically you can still receive your passive income without the government taking a bunch up front. So this includes exempt interest, a dividend that is exempt income, derived by a person who holds an RWT exemption certificate, or paid by a person when the interest paid totals less than $5,000 per annum. So it's basically either exempt income, which you don't need to include in your tax return anyway, and therefore there's no taxes required to be paid, or it's a small amount, so less than $5,000. So how much does the government actually withhold for passive income, whether it's interest or dividends? Well, it depends. So for an individual, it depends if they've supplied their IRD number, in which case they can elect the rate, which is, this is for interest by the way, which that rate they can elect is between 10.5% to 33%, and this is basically dependent on how much tax they're expected to pay at the end of the year. But if they don't supply their IRD number, the default rate of 33% will apply, which you'll notice is the highest marginal tax rate for an individual. Now, if you're a company that have supplied their IRD number, the rate is 28%, which makes sense because it's a flat rate, no change. So it's just the highest rate as well, 20%. Next, the RWT rate for dividends. This is a flat rate of 33%, interestingly, if you are a New Zealand tax resident. So it's the highest tax rate applied to dividend withholding, but of course that can be reduced by any imputation credits attached. Okay, so the next thing that we're going to be talking about is provisional tax. So what provisional tax is, again, to help with cash flow. And let's say you've got, you're based on your monthly P&L, let's say you're making 10K a year. So that if you continue that same rate, by the end of the year, you'll have made 120K profit. So you've got a fairly good idea at each given point how much tax you have to pay at the end of the year. So what provisional tax is basically when you're making installments each or throughout the year, so that it's similar to PAYE, but you're most likely not an employee, so you don't get PAYE. If you're running a business or something like that, you can actually contribute that money throughout the year. So again, to also help with cash flow once you actually lodge your tax return and don't have to pay, 30 grand upfront in tax, which most people just don't have sitting around. So under RC, a person is required to pay provisional tax for an income year if their individual income tax for the year is more than $2,500, or they choose to pay provisional tax. But the following people do not pay provisional tax. So non-resident companies that do not have a fixed establishment, non-resident contractors who have not been given an exemption certificate, and multi-rate investment entities that do not make an election. If you're not sure what these are, we're going to cover this later on in this notes. It gets a little bit challenging when we start talking about this stuff, but don't worry about it too much for now. You can just kind of memorize these ones. Okay, so how do you actually calculate how much tax you have to withhold, to pay the government each month? Well, there's basically 4 methods in order to actually calculate what your provisional tax is. So number 1 is the standard method. So the formula is just over here. So you basically check your preceding year, you times it by your uplift, and the rates are over here. And that's it. So primary uplift 105%, or 110% if the prior year return is not due before the first or second installment. So it's either one of these rates. So you just take whatever your income was last year, times it by 105% or 110% if you satisfy this, and that's how much you have to pay for the year. And obviously just divide it by the number of installments you actually have to make. Next is estimation method, which is basically, as long as it's a fair and reasonable estimate, that is valid. And the third one, which is out of scope, so don't worry about this one too much, is accounting income methods, just paying based on your accounting. And then finally is GST ratio method, which we discuss in detail down below. So this is the GST ratio down here. And the premise of this method is that it's based on the cash flow of the business, right? And that the Commission knows about the cash flow of the business because the business lodges GST returns, right? And the GST returns are a reflection of how much they're selling, what are the purchases it's making in order to claim net GST. So by that logic, it also is a good proxy in very almost real time of the cash flow business of the business. So the purpose of this method is to let's estimate on a monthly basis and then year to date what the cash flow of the business is, because that should be a good proxy of taxable income at the end of the year, and therefore the amount of the tax payable based on that taxable income. So in order to do this method, the amount of installment tax paid in the previous year must have been more than $2,500 but not exceeding $150,000. So the other requirements to use this method is they must have been registered for GST for the entire preceding income year. The preceding income year must not have been a year in which the business operations began. The ratio of the RIT to total GST taxable supplies, expressed as a percentage, must be between 0% and 100%. And the GST returns are filed either on a monthly or 2-monthly basis. So if you satisfy all of the above, including the dollar amount up here, you can use this method. And the formula for using this method is as follows. It's residual income tax times installment number divided by total installments minus provisional tax. So the definition for each of these fields is listed below. So residual income tax is the RIT for the preceding year, uplifted by 5% or 10%, depending on the same rule we discussed up here, right, under the standard method. So basically take how much tax you paid last year, add it by 5% or maybe 10% depending on your situation. And then installment number is the number of installments, each installment for the income year. So it's either generally 1, 2, or 3. And then the total installments is the total number of installments for the year. So for example, if we're doing the second installment out of 3, we'd go times 2, divide by 3, because 3 is the total. And then finally, the provisional tax is the amount of provisional tax already paid to date for the income year. So each period, it's going to say, okay, times 1 over 3 minus provisional tax. So the first one's going to be 0. Then that's going to roll over into your provisional tax for the next run. So by the second installment, you're going to go residual income tax times installment number 2 over 3 minus the amount of tax you paid last time, and so forth. So the different dates that each of the installments are due are down here. Now, most businesses in New Zealand have a default balance date. Balance date is basically like the financial year at 31 March, which aligns with the income tax year. So, of course, you can change that date if you want to. For example, if your parent company has a different date, or if your industry has a certain standard date you want to align to, you can ask the Commission to change it. That's fine. But generally, those installments are paid at these dates in this table down here. And now, there's also a early discount payment as well for small business taxpayers only, which is a tax discount of 6.7% if you pay voluntarily in the year before they begin paying provisional tax. Now, obviously, if you can invest money and you can get like 10% a year, whether that's in the stock market, whether that's investing in your business, in inventory or whatever it is, working capital, you can probably get a higher return, like 10% or something like that. So what's to stop you from just holding off your tax payments until as late as possible, and then just using that money during the time, getting a 10% return? You keep that profit and then you lodge a return late, pay the amount that you owe, and you get the benefit of whatever interest or return on that money you've generated. Well, to counteract that, there's the use of money interest regime in Part 7 of the Tax Act 1994. And this is basically designed to compensate the Commissioner for the loss of money caused by taxpayers by paying tax too late. So what it does is it effectively pays an interest rate of whatever the rate is at the time. In this case, it's 7%, to make up for the fact that the Commissioners to make up for the fact that the taxpayer's been using that money. And there's this big differential as well between the rates. So the Commissioner, if they owe you money, they only pay 0%, whereas the taxpayer, if they owe the Commissioner money, they're going to pay a late payment fee or interest fee of 7% per annum. And this is quite recent, since 8th of May 2020. So quite an unfair discrepancy there, but it's meant to encourage you to pay your installments on time or early. Especially with that discount up here for small businesses, it's going to be a strong incentive for small businesses to pay their tax early. So if the Commissioner were to charge you interest, this is the amount of interest that you would be charged. It's calculated as follows. So the formula for that is T times R divided by 365, where T is the amount of unpaid tax and R is the rate that applies on the day. So in this case, it's 7% a year. Divide that by number of days. Yep. So, okay. So there's also the safe harbor for taxpayers, and what this means is it's a common term in tax, safe harbor. It's basically if you're in this area, you don't have to. You're not at risk. Basically, like think of a boat. If there's a storm out there, they can go into this harbor. It's safe. They're protected as long as they're in that harbor. So it's generally, if you're a small taxpayer, we're not going to charge you this. But if you're a large taxpayer, we will. So the thresholds for safe harbor criteria is residual income tax less than 60K. And it's only for taxpayers using the standard or estimation methods. So you can't use it if you're using the other methods. So you can't use either of those two methods, accounting income or GST. Okay, and there's also the concept, before we move on, of tax pooling. So what this does is to prevent the risk of you being incurred any late fees or use of money interest, what you can do is do something called tax pooling. So what tax pooling is effectively kind of like an offset account and a mortgage. What you do is you pay your money into this, and that pool basically offsets any tax payments that you might owe to the government, and it reduces the risk of underpayments for the taxpayers in the pool. That's all you really need to know, what it is at a high level. So let's talk about the ethics of tax now. So there's a couple of important concepts we need to discuss. So tax planning, tax avoidance, and tax evasion. They're all on the same scale at different ends of legality and ethicality. So let's talk about the first one. So tax planning, also known as tax minimization. So this is basically when you're aware of all the tax laws and you organize your tax affairs in a way that you reduce your tax liability whilst you're acting with both the letter and the spirit of the tax law. And what that means is, letter, you're following what it says in the law, basically. But you're also following the spirit, which means the meaning or what was originally intended. And of course, there's different ways to structure affairs. So some might increase your tax, some might reduce your tax. It's all legal, it's all perfectly fine, right? It's well within your right to do tax planning and tax minimization. Now, as you head further down the scale of, legality and ethicality, you start getting into this gray zone, which is called tax avoidance. And this is when you do follow the letter of the law, like, you follow exactly as it says, and maybe there's a loophole in there, or maybe there's something that the legislators didn't think about, or maybe you're, willfully ignorant to the interpretation of something. But either way, you might be legally following the law, but you're not following the intention of the law. This is called tax avoidance, and it is legal, but it's unethical. Now, the further you head down this, you get to evasion, and this is just plain illegal, and it's also unethical, and you can have some very serious penalties from doing this, which we'll talk about a little bit later in this chapter. So what this is basically a false, misleading statement or omission of information. So maybe you earn 200K a year and you tell the government you earned 50K, knowing that you earned 200K. So that would be a false, misleading statement. That would be tax evasion. The other way to do it is omission of information. It's basically where you don't say the wrong thing, but you just don't tell them about something. Now, there's anti-avoidance rules, and anti-avoidance rules come up throughout many different chapters in the tax module. It's basically generally a catch-all provision, and it's meant to kind of stop, especially these ones where it's maybe legal but unethical, right? And it's meant to be, if we didn't think of something, then refer to the anti-avoidance, which says along the lines of, you're not meant to, deliberately try and get around loopholes and things to minimize your tax. That's basically what these say. So what this is saying is it's the IRR's last line of defense against avoidance activity, because it's such a catch-all. So if the legislators miss something and the taxpayer said, look, I followed it to the line, well, the legislator will say and the commissioner will say, just refer to anti-avoidance provisions and we're going to get you on that, right? Because you didn't follow the anti-avoidance provisions, which is meant to, the rule is follow the intention of the law and the spirit of the law. And if you don't do that, then it's avoidance. Okay, Now, in terms of how do you actually figure out whether tax avoidance occurred, especially in those situations where it's a bit of a grey area, well, the Parliamentary Contemplation Test is a commonly used test for tax purposes in order to figure out what the intention of the party was. And if the intention of the party was, to avoid tax, then you can, issue penalties on this basis. So let's talk about how this Parliamentary Contemplation Test actually works. There's a diagram on the next page. So, now you might not actually need this, but it's just good background information. So we just basically flow this flowchart down to analyze a certain situation, whether that's the taxpayer has, shifted its profit overseas through a legal mechanism, whatever that is. So what we need to do is we need to understand, does this count as avoidance? Even if the taxpayer has followed the specific act that relating to that to the letter of the law. So the first step is to look at the arrangement, its tax effect. So we're looking at all the steps and transactions that made it up. So, who did they involve? Did they get advice? Did they go through a scheme? How closely have they followed the letter of the law? What was their kind of intention in doing so, and how did they go about doing it? Next is the tax avoidance phase. So this is the Parliament's purpose step. So you need to look at the Parliament's purpose for each of the relevant provisions from the text. So what is don't just look at the letter of the law, but what is the true purpose of this specific act? And the act might be, in this case, shifting profits overseas, and the method that they've gone about it. There might be some specific acts relating to that. You also need to identify any facts and attributes. They need to be present to give effect to that purpose. And you need to look at it from a commercial reality. So don't just look at the letter of the law by itself. You need to look at the whole case. Like, what are the facts of the economic situation that are present, which might give some context to the intention. Okay, so the next flowchart, we've just split it over two sections. Does the arrangement viewed in a commercially and economically realistically way? Because obviously there's a difference on paper and in real life. So this is why we just do this parliamentary test. Is it used to circumvent the relevant provisions in a manner that is consistent with the Parliament's purpose? So in simple terms, what is the underlying meaning of the act, and has this acted in a way that was consistent with the purpose in the act? So if the answer is no, they haven't acted with the intention of the Parliament, then the arrangement has tax avoidance as a purpose. And the next question is it merely incidental? So was there any other, i.e. non-tax avoidance purposes that we should be considering that might have detracted from this? If the answer is no, then section BG1 applies, and basically tax avoidance will be deemed to have occurred, and obviously the penalties associated with that, which we'll go through quite shortly. So if we have found that the arrangement under BG1 was used for tax avoidance purposes, then the Commissioner has two powers. Number one, the arrangement is void. So whatever was agreed, whether that was a borrowing agreement between parties in two countries, whether that was a dividend, whether that was a pricing agreement with a parent company overseas, the Commissioner can come in and say that is void. There's no agreement. It's not valid. Okay, I'm going to go in. And then the second point is reconstruction. So not only is the original agreement void, but the Commissioner is going to come in and say what should have been reported if the scheme didn't exist. So maybe if there's a transfer pricing arrangement going where the New Zealand company has issued or sold things at a below market price to shift things overseas or shift profits overseas, what the Commissioner can go in and say, well, actually the market rate for selling it should be 3 times as high as what you sold it for. Therefore, you should be reporting this income, and you're going to pay tax on that higher amount. And obviously, that's going to result in a much higher tax payable amount. Now, there's also a couple of specific anti-avoidance rules which I wanted to talk about, which are just obviously there's more anti-avoidance rules in this, but these are the really important key ones. So the first one is dividend stripping. So the purpose of dividend stripping under section GB1 is to prevent a taxpayer from selling shares in a company for money in substitution of a dividend that would have otherwise been paid to a taxpayer. So as dividends are generally taxable arrangements to disguise a dividend as non-taxable income will reduce the taxpayer's income tax. So this is a problem kind of unique to New Zealand purely because they don't have capital gains tax. Now, what happens in this situation is because dividends are income, whereas a capital gain is not, a shareholder in New Zealand is incentivized to maximize the capital gain and minimize the taxable income. So to do that, they want to prevent dividends in New Zealand, because if they prevent dividends in New Zealand, it means there's more cash in the business, and it means the business will sell for more. And if the business sells for more, higher capital gain. So they basically shifted income to capital gains, and they will minimize their tax payable. So the dividend stripping rule is to prevent a taxpayer from selling shares in a company in money substitution for a dividend. So this kind of steps in and says, well, this company should have paid a dividend, so we're going to deem a dividend has occurred and actually assess you on that basis, even if they've tried to just leave it in the company. Hopefully that made sense. And that's under section GB1. So the other really important anti-avoidance rule that we want to talk about is personal services income attribution, or PSI. And you might have heard of this. This is basically when, actually I mentioned it in the last video, it's basically when you've got an individual who's at a high tax rate. So the highest rate is 33%, right? Whereas companies are taxed at 28%, or maybe they can get an even lower tax rate in a different entity. So what the taxpayer might do when they're operating as a personal services, so that's like a lawyer acting as a sole trader, accountant, plumber, whatever it is, they set up a company, but the company isn't operating as a business. It's really just a mechanism for them to do their personal services. So they're just acting as a lawyer, they're just acting as a small accountant, small plumber, and issuing invoices. So that's all. That's effectively just income that they're generating from their own personal exertion, right? Their own personal work. So that is personal services income. But it's when it's going through a low tax entity, like a company, for example, they're actually doing the same thing as someone else, but the other person's paying 33% and they're paying 28%. So what this does is it actually, when that occurs, where it's personal services through a low tax entity, it actually deems that income to be payable by the individual, and they actually have to pay it at the higher rate of tax, not through the company. Okay, and then just quickly talking about the ethics for tax advisors. It's not a huge part of this module. It's in most of the modules, really. We at least talk about it at least once in all of the modules. And the ethics are relatively the same across all of them because they are linked from the APSB, I think it's called. And it's the 5 codes of ethics for tax advisors and also accountants as well as the same one. So it's integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. I don't need to spend a lot of time on them. Hopefully you know what they all mean. Anyway, moving forward. So dispute resolution process. So this is basically when you lodge your tax return and the commissioner says, I disagree with this, I'm going to lodge an amendment. And then you said, well, I disagree with your interpretation. So what I'm going to do is I'm going to lodge a dispute resolution process. So the process for this is set out in Part 4A, which is for disputes where an assessment is raised, and Part A, which is after a disputed assessment is raised. So the first one, Part 4A, Preassessment disputes, and this is basically when the commissioner can initiate a dispute by issuing a NOPA, which I mentioned earlier in the chapter. So the commissioner will initiate a dispute if they wish to adjust the taxpayer's self-assessed position or an earlier commission's assessment. So the commissioner cannot increase the amount of tax assessed after 4 years have expired from the end of the tax year in which the taxpayer has filed the relevant return, unless the return is fraudulent or willfully misleading, or the return omits mention of income of a particular nature or derived from a particular source. In those cases, there's no time limit on fraud. So the next one, which I mentioned earlier, which is Part A, which is after a disputed assessment is raised. So the taxpayer may not contest the correctness of an assessment or other disputable decision by the commissioner, except under the challenge procedure. So the challenge procedure outlined in Part 8A. A taxpayer may challenge an assessment in a hearing authority and must commence proceedings within 2 months of the date the commissioner issues the relevant disputable decision. So burden and standard of proof. So in civil tax cases, the burden of proof is always on the taxpayer, and the standard of proof is the civil standard of the balance of probabilities. So this is interesting because if it's in a civil tax case, which most tax cases are, as opposed to criminal, right, which is just, it's usually to do with crimes, violent crimes, stealing, theft, things like that. Generally, tax doesn't come under the criminal proceedings unless it's super serious. For 90% of the time, it's just going to be a civil tax case. And it's interesting because in that case, the burden of proof is on the taxpayer, whereas in a criminal case, the burden of proof rests with the commissioner, which is ideal for the taxpayer because it's hard for the commissioner to prove that an issue exists. But whereas in a civil case, the taxpayer has to prove that it's not an issue, which is a bit harder. So anyway, let's talk about penalties now, which I've mentioned a couple of times. So let's say the commissioners, reviewed something and they found, some issues with your tax return. Maybe you've omitted income, maybe you have accidentally missed something, whatever it is, and they might have amended your return. On top of this, the commissioner can issue penalties, right? There's 5 categories of penalties, and each of them have a different rate depending on how serious the issue was. So the first one is lack of reasonable care. That's a 20% penalty. And we'll talk about examples of this down below in a second. Number 2 is unacceptable tax position. That's 20% penalty. Number 3 is gross carelessness. That's 40% penalty. Number 4 is adopting abusive tax position. That's 100% penalty. Number 5 is evasion. That's 150% penalty. So you can see this slowly getting more serious and the penalties are increasing as well. So let's talk about example behaviors of each, and there's examples from the CSG which I've got down below as well. So, and you can see they correspond with different categories up here, lack of reasonable care. So an example of lack of reasonable care would be a taxpayer who fails to take the same care as a reasonable person. For example, a lack of a system to record income expenses and a reliance on advice where not necessary. An example of an unacceptable tax position is they fail to meet the standard of being as likely as not to be correct. So it must be one capable of being seriously considered by the court and only applies when the tax shortfall is less than $50,000 and 1% of the taxpayer's total tax figure. Number 3 is an example of gross carelessness, which is starting to get a little bit more serious because this has a 40% penalty. An example of that is doing or not doing something in a way that all the circumstances suggest or implies complete or high-level disregard for the consequences. In other words, recklessness. Okay, and then getting more and more serious, which is more than double the penalty now, which is 100%, and this is adopting an abusive tax position. So what this means is a position, or an example of this is a position based on an unacceptable tax position and has tax avoidance as its dominant purpose. Signs include artificiality, contrivance, circularity of funding, concealment of information, and unreliable interpretations of the law. And then finally, the worst of all, which is evasion, which we talked about above, which is, willfully, stating things which are fraud or omitting information. So there's actually no statutory definition of evasion. It has to be just proven through the facts. So it's commonly regarded as involving knowingly taking steps to escape one's tax liabilities, either by evading assessment, i.e. failing to file returns or filing returns that are known to be false, with the intention that the commissioner will assess a lower tax liability. So we've got some examples here which you can read through if you like, but I think we've pretty much covered those penalties. But as I mentioned before, there's 2 sides to the commissioner. Obviously they can issue penalties, but they can also have the power to do some good things as well. So the commissioner can actually reduce penalties in certain situations. So good behaviour, they can reduce the penalty by 50%. If there's a pre-audit voluntary disclosure, which is basically the taxpayer reveals all of the details of the shortfall voluntarily before any audit or investigation takes place. And in that case, it can be reduced by 75% or 100% in some instances. But if it's after the first notification, you can still get a reduction, but it's still before the tax audit. You can still get a reduction, but it's not as high, so it's 40%. So the key difference is notification of a pending tax or audit investigation. So if you tell the commissioner about everything before you even get a notice that there may be an audit or investigation, you get a 75% or 100% in some instances. The third potential reduction in penalties is disclosure of tax position at time of filing. And this is basically where you take a tax position, maybe it's interpreting a particular law or provision, and believing it's correct, but there is a risk that the commissioner may interpret it differently. So what they do is they make disclosure of that at the time of filing the return to the commissioner, and if there is a penalty, it's reduced by 75% under this basis. Next is a temporary shortfall, and a penalty would be reduced by 75% if the taxpayer has permanently reversed or corrected the shortfall. And then finally is no double reduction. And this is basically where there is a combination of early reductions and the shortfall being a temporary shortfall. Any voluntary disclosure of this shortfall would be reduced by 100% if the shortfall relates to not taking reasonable care, and the other 2 points below it. Okay, but if there's on top of the existing penalties, the Commissioner can actually increase the penalties by another 25% if the taxpayer obstructs an officer. And of course, there's also late payments as well. So the late payments are 1% of the unpaid tax or 4% of unpaid tax a week after the due date, if it's still not lodged at that point in time. Okay, cool. So that is the end of Unit 2, providing an overview of the New Zealand self-assessment system and the powers of the Commissioner and so forth. So hopefully you found that useful, and I'll see you in the next video.